When it comes to investment, the most common mistake people make is they either become highly conservative and keep all the money in saving account, FD or gold, or people become highly aggressive and invest all the money in stock market, especially in the mid-cap stocks. Some people even invest money in penny stocks with a hope to generate multi-bagger returns in short time. Now, these are two extreme sides of investment, and none of the approach is right. So, what is the right approach to investment? How to build a diversified investment portfolio, and more importantly, how to rebalance the portfolio, because it is very important to not just build a diversified portfolio but also rebalance it as per market condition. Hello everyone, my name is Sahil and this is my Personal Finance Academy. As an investor, I am sure you would have come across multiple options of investment, be it FD, insurance, PPF, gold, real estate, post office scheme, bonds, mutual funds, stocks, etc. Then within mutual funds, there are many categories, and stock market is an ocean. You have nearly 2000 actively traded companies on stock exchanges. It gets really confusing and difficult to select right investment option. Especially now that the stock market is down, what should be the investment strategy and how to rebalance the portfolio? So today I want to discuss about the strategy to build a diversified portfolio. And I will be also sharing the rebalancing strategy that I have learned from one of the best books written in the field of investment. But before that, let us first try to understand what are the asset classes we have and what are their risk versus return profile. And then we'll look at how to build a diversified portfolio and how to rebalance it. So first asset class is fixed income instrument. As the name suggests, fixed income instrument offer a fixed return irrespective of market condition. For example, you can do a fixed deposit for let's say 5% or 6% fixed interest rate where you will get a certain interest on top of your principal amount, provided you have done FD with a reputed institute, because people even lose money in FD by falling in greed for high interest rate with local finance companies or even end up investing in Ponzi schemes. Apart from FD, there are multiple fixed income instruments. You have PPF, National Savings Certificate, Sukanya Samriddhi account, etc. Then you also have few categories of insurance that offers fixed return on maturity. Then another category which generally people are not aware is bonds. There are corporate bonds that offers a fixed interest based on their credit rating. This interest can range somewhere between 7 to 11% based on credit rating of the company. A company with high credit rating will offer a lower interest, and a company with lower credit rating will offer a higher interest. It's always better to buy bonds of companies with high credit rating. Then even Indian government offer bonds called GSEC, that is government security bonds, that offers fixed return which is currently around 7.5%. The advantage with fixed income options are that your returns are not volatile. However, the returns are on the lower side. Then second asset class is equity, where you can invest directly in stocks or you can invest in equity mutual funds. Now this is a high risk and high return instrument. The returns are not fixed and they are highly volatile. Although this volatility would vary from stock to stock and mutual fund to mutual fund. Especially within stock, the volatility is very high. But at the same time, if you identify good quality stocks, then it can also help you generate multi-bagger returns. Again, there are various categories within equity like your large cap, mid cap, small cap, then sectoral categories like banking, IT, manufacturing, etc. Then you can also diversify by investing in foreign markets like US. Then third asset class is real estate. While real estate is a good option to invest money, the problem is that it requires a lot of money to buy a piece of land or flat, especially in metro cities. On top of that, the real estate prices are also very expensive. Another problem with real estate is liquidity. When you want to sell the property, it is not easy to find the buyer. So you can diversify in real estate when you have made enough money and invested in both fixed income and equity market and do not have any liability. By the way, these days you have another great option called REIT, that is Real Estate Investment Trust. It works like mutual fund wherein it pools capital from investors and invest in properties. Investors can earn dividend from these investments without buying, managing or financing any property themselves. Some of the listed REITs in India are Embassy Park REIT, Mindspace REIT, etc. So here you don't need huge amount of wealth. You can invest in REIT even with few hundred rupee. Maybe I'll create a separate video on REIT. Then fourth asset class is gold. Now one good aspect with gold is that it is highly liquid investment option. Basically you can sell gold whenever you want. So it is very useful in case of emergency. But again, gold generates limited return. On an average, the returns are in the range of 7 to 8%. So it can beat the inflation but can't create wealth for you. Hence, you can invest in gold but keep it as a hedging option against equity market, because when the equity market fall, there are high demand for gold. But don't consider it as an investment. Maybe you can keep 5 to 10% in gold and don't buy the physical gold. They have high charges. Today you have multiple options to invest in digital gold, be it in the form of gold ETF, gold mutual fund, or simply digital gold. But my favorite option is SGB, that is Sovereign Gold Bond. It is issued by Indian government and you also get additional 2.5% annual interest on top of your gold price appreciation. And there is zero cost involved in SGB investment. Now before we discuss how to build a diversified investment portfolio, we have a sponsor for this video. It's OctaFX. It is a forex trading broker with 11 years of experience in the market where you can trade currency pairs. Comparing to stock market, forex market works 24/7, so you have more time to trade. Now, most of you would be unfamiliar with forex trade, but you would be surprised to know that forex trading is even bigger than stock market in terms of volume. Globally, there's an average daily volume of $6.6 billion in forex market. It includes players like your commercial bank, hedge funds, investment managers, MNCs, as well as retail participants. So you can buy and sell currencies using OctaFX platform. It has the lowest spread and charges, no swaps, and no commission. For the beginners in forex trading, OctaFX provide educational content on their platform, webinars, and even live trade session so that you can learn the basics of forex trading. They also provide a demo account before investing real money for real profit. And along with trading in currency pairs, there are many other assets that you can invest in, such as gold, oil, etc. And there are multiple payment methods through which you can make deposit in your OctaFX account. You can use my link in the description box to start trading with OctaFX. And if you use my promo code, you will get a 100% deposit bonus. Now that we have discussed various asset class, the biggest question is how to build a diversified investment portfolio. So first of all, when it comes to investment, there is nothing called one size fit all. For example, if your friend or relative is investing in a specific stock or mutual fund, then it is not necessary that it is also good for you. Everything boils down to two factors. What is your financial goal and what is your risk appetite? Let me explain this. So what is a financial goal? Ultimately, we are all investing the money to fulfill our financial goal. It could be to buy a home, could be to buy a car or go for a foreign trip, or it could be your children's education or retirement planning, or simply investing for wealth creation in the long term. So first of all, you need to identify your financial goal and accordingly select the asset class. For example, if you have a financial goal where you need money for emergency purpose, or let's say within 2 to 3 years, then you should not invest in highly volatile investment of equity. You should invest in fixed income instrument for your short-term goals. If you have a long-term goal, then you should invest in equity, including both stocks and equity mutual fund. It is because stocks and equity mutual funds are volatile. So it can happen that you invest today and within 1 year, your portfolio falls 30, 40, 50%. However, in the long run, equity investment generates great return. And when I say long run, it is more than 5-year period. Of course, it was not a straight line return. There were many ups and downs. Now, apart from financial goal, you should also look at your risk appetite. See, every person doesn't have the appetite to take risk. When I say risk, in stock market, it is basically the volatility in your portfolio. As discussed before, stock market can fall as high as 30-40% from the peak, and not every person has the courage to see their portfolio in red. Especially people in their 50s or 60s do not have that kind of risk appetite. So before you construct your portfolio, just check what is your risk appetite and accordingly decide how much you should invest in fixed income and how much in equity. Now, generally when you are in your 30s or 40s, you will have more than one financial goal, like buying a house, children education, emergency fund, and retirement plan. In that case, you need to build a diversified investment portfolio. If I give my example, even I have multiple goals, be it buying a house, my child education, emergency fund, and retirement plan. So what I have done is I have invested 60% of my money in equity instrument and 35% in fixed income instrument and 5% in gold. So my 35% investment in fixed income asset is mainly in bonds that take care of my emergency fund and short-term goals like travel. Moreover, I've kept some cash handy in liquid fund to invest in equity market in a systematic manner to take advantage of this falling market. I will discuss more about this in the later part where we'll look at the portfolio rebalancing. Now within equity, I have 40% of my money invested in stocks and 20% in mutual funds. Again, within mutual funds, earlier I had investment in active funds, but now I am investing all my money in index funds, especially Nifty 50 based index fund, and a small amount in US based index fund. Within stocks, I have nicely balanced my money across large cap, mid cap and small cap, with large cap contributing nearly 25% and remaining 15% in mid cap and small cap. Again, I have done some rebalancing that I will discuss shortly. Earlier, I had higher allocation in mid cap and small cap, but now I have increased my allocation in large cap. I have made sure that money is nicely diversified across sectors including banking, IT, technology, automobile, manufacturing, chemical and so on. Again, I have done some rebalancing recently where I have increased my allocation in banking sector. Now let us discuss this rebalancing strategy. Portfolio asset rebalancing is very important aspect of your financial planning. It is important to rebalance the portfolio periodically based on economic condition. But the question is, how to rebalance the portfolio? Now, I have learned the art of portfolio rebalancing from the book called The Intelligent Investor, written by Mr. Benjamin Graham. This book says that you should invest in equity and fixed asset in the ratio of 50-50 and then keep on rebalancing it as per the stock market valuation. For example, if the stock market becomes expensive, then you can reduce your exposure up to 25% and increase exposure in fixed income instrument up to 75%. And if the stock market valuation becomes cheap, then you can increase the stock exposure to 75% and reduced fixed income instrument exposure up to 25%. For example, last year during 2021 bull run, stock markets were very expensive. That was the time to reduce exposure in stocks. Currently, I have 60% allocation in equity with 40% in stock and 20% in equity mutual fund, and within stock, I have 25% in large cap and 15% in mid and small. Until last year, I had nearly 25% allocation in mid and small cap, but now I have rebalanced the portfolio with higher allocation in large cap. And if there is further correction or sideways movement in stock market for 2022, then I will increase the exposure in equity from 60% up to 75%. So basically, I'll withdraw my money from fixed income asset and move it to equity market, including both individual stocks and equity mutual fund. Also, the additional investment that I do every month is now going in equity asset class to make sure that my allocation increases up to 75% as the market corrects further. Although this allocation doesn't talk about gold, but you can always have 5 to 10% exposure in gold as a hedging instrument against equity market. Now the important question is how to check the valuation. So how would you know if a stock market is expensive or cheap? For that, you can look at the P/E ratio of Nifty. That would give you a good understanding of Nifty valuation. Generally, Nifty PE is in the range of 20 to 25. If it exceeds the level of 25, it becomes expensive. And if it falls below the level of 20, then it becomes cheap. Currently, Nifty is trading at levels of 1920, so it is looking attractive. But again, investment is not a science. You can't just use one formula to decide everything. You got to keep an eye on the economy, the key macro factors like interest rate, inflation, oil prices, corporate earning, etc. to gauge the market condition. And you will learn this with time as you gain more and more experience. So in this video, we discussed the different asset class in India and how to build a diversified investment portfolio as per your financial goal and risk appetite. Then we also discussed the important aspect of portfolio rebalancing and how you can use asset reallocation formula from the book The Intelligent Investor. I also discussed my asset allocation and investment strategy. But before we close this video, let me be very clear. When it comes to investment, there's nothing called one size fits all. So you need to do your own research to understand what is right investment option for you. Do not blindly invest based on tips. Now tell me in the comments how much percent you have allocated in equity and how much in fixed income asset. I hope you find this video useful. I'll see you next video. Till then, take care.